Right now, over 100 million Americans are either uninsured or underinsured. That number is not a typo. 100 million. And here's what's even more shocking. 66.5% of all bankruptcies in the United States are caused directly by medical bills. Medical bills. Think about that for a moment. 2 out of every 3 Americans who go broke do so because they couldn't handle healthcare costs. This isn't just about sick people. This is about regular people with regular jobs who thought they were protected. And I'm about to show you exactly how to choose the right insurance so you never become one of these statistics. By the end of this video, you'll know more than 90% of people about insurance. You'll make smarter choices. You'll save thousands of dollars. But first, let me tell you the biggest mistake people make when buying insurance. A mistake that could cost you everything. Stay with me. Let me break this down simply. Insurance is a deal. You pay a company money every month. In return, if something bad happens, they pay your bills. That's it. A simple trade. This is like paying a small fee every month so that if your house catches fire, your car gets stolen, or you end up in the hospital with a broken leg, someone else covers the huge bill. The money you pay monthly is called a premium. Think of it as a membership fee. You pay this whether you use the insurance or not. The premium keeps your protection active. Now, there's something else you must understand before choosing any insurance. Something that confuses millions of people. Something that I'll reveal in just a moment. Here it is, the deductible. This is the amount you pay first before your insurance starts paying. For example, if your deductible is $2,000, you pay that amount out of your own pocket before your insurance kicks in. Think of it like this. If you have a $20 copay at the doctor and a $2,000 deductible, that copay doesn't count toward your deductible. You'd have to spend the full $2,000 on covered services like hospital stays or surgery before your insurance begins helping more. Low deductible means high premium. High deductible means low premium. This is how insurance companies balance their risk. You're choosing between paying more now or paying more later. Here's the secret most people don't know. Only 44% of Americans can pay an emergency medical expense of $1,000 from their savings. If that's you, keep watching closely. I have a strategy for you. Remember this golden rule. The higher your premium, the lower your deductible. The lower your premium, the higher your deductible. They work like a seesaw. So what does this mean for you? If you're healthy and rarely go to the doctor, a high deductible plan makes sense. You pay less each month. But if you get sick a lot or have a family, a low deductible might save you money. Here's a real example. A person paying $200 monthly with a $500 deductible pays $2,900 per year total if nothing goes wrong. A person paying $100 monthly with a $5,000 deductible pays only $1,200 if healthy, but could pay $6,200 if something bad happens. Which one is right for you? That depends on your health, your savings, and your risk tolerance. But don't decide yet. I have more secrets coming up. Let's talk about the 5 main types of insurance everyone needs to know. Health insurance, life insurance, auto insurance, homeowners insurance, and renters insurance. Each one protects you differently. Health insurance covers your medical bills. Life insurance gives money to your family when you die. Auto insurance covers car accidents. Homeowners insurance protects your house. Renters insurance protects your stuff if you rent. Here's a scary fact. 92% of Americans have some health insurance, but that means 27 million people have none. And even those with insurance often have the wrong kind. Over the next sections, I'll show you exactly how to pick the right plan for each type of insurance. This knowledge alone could save you from financial disaster.
Let me show you something terrifying.
Nearly 1 in 4 working-age adults in America are underinsured. That means their insurance isn't enough to protect them. And get this, 57% of underinsured adults avoid getting health care because of the cost. They skip doctor visits. They don't fill prescriptions. They let problems get worse. This is like ignoring a small leak in your roof because you can't afford the repair, and then watching your entire ceiling collapse 6 months later when you really can't afford the bigger repair. The result? 2 in 5 people who delayed care said their health got worse because of it. This isn't just about money, it's about your life. There are 4 main types of health plans: HMO, PPO, EPO, and POS. Let me explain each one simply so you can make the right choice. HMO means Health Maintenance Organization. You must pick a primary doctor. That doctor sends you to specialists. You usually can only use doctors in their network. This is the cheapest option. PPO means Preferred Provider Organization. You have more freedom. You can see any doctor without a referral, but it costs more. You pay less if you stay in their network, more if you go outside. EPO is similar to HMO, but without needing a primary doctor. POS is a mix of HMO and PPO. Each type has trade-offs, and I'll show you exactly how to pick the right one for your situation. If you're buying insurance through the marketplace, you'll see metal tiers: bronze, silver, gold, and platinum. These tell you how costs are split between you and the insurance company. Bronze plans pay about 60% of costs. You pay 40%. These have the lowest premiums but highest deductibles. Silver plan deductibles typically exceed $5,000. Gold plans pay about 80%. Platinum pays about 90%. These cost more monthly, but you pay less when you get sick. Here's the trick most people miss. For low-income families, silver plans come with special cost-sharing reductions that make them a better deal than bronze. Don't just look at the premium, look at the total cost. High-deductible health plans, or HDHPs, are everywhere now. The IRS defines them as having deductibles of at least $1,700 for individuals or $3,400 for families. Here's what nobody tells you. Research shows people with HDHPs aren't shopping around for cheaper care. They just skip care altogether. This defeats the whole purpose. It's like having a gym membership you never use because parking is too expensive. You're paying for something but not getting the benefit. But HDHPs have one huge advantage. They let you open a health savings account, an HSA. This is a tax-free way to save for medical expenses. I'll tell you exactly how to use this to your advantage in a moment. Listen to this. A health savings account is like a superpower for your money. You put in pre-tax dollars. It grows tax-free. And you spend it on medical costs tax-free. That's 3 tax benefits in one account. In 2025, you can contribute up to $4,300 as an individual or $8,550 for a family. And the money rolls over every year. It never expires. Here's the strategy. Choose a high-deductible plan with lower premiums. Put the money you save into your HSA. Now you have a fund ready for emergencies and you're saving on taxes. After age 65, you can use HSA money for anything, not just medical expenses. It becomes like a super retirement account. This is one of the best-kept financial secrets in America. Now let's talk about life insurance. This is how you protect your family if you die. Only 52% of Americans have life insurance. That means half of all families have no protection. And here's the tragic part. 30% of Americans would suffer financial hardship within 1 month if the main income earner died unexpectedly. 1 month. That's all it takes for families to fall apart financially. This is like living on the edge of a cliff with no safety net. One small push and everything falls. Life insurance fixes this problem. You pay a small amount each month. When you pass away, your family gets a big payment. This money pays the mortgage, covers bills, and keeps them safe. But here's the mistake most people make with life insurance. They buy the wrong type. Let me show you the difference. There are two main types of life insurance, term life and whole life. The difference could cost you thousands of dollars. Term life insurance covers you for a set time, like 10, 20, or 30 years. It holds about 19% of the market. If you die during that time, your family gets paid. If you don't, the policy ends. No payout. Whole life insurance covers you for your entire life. It also builds cash value that you can borrow against. It makes up about 37% of the market. Sounds better, right? But here's the truth. Whole life costs 5 to 15 times more than term life for the same coverage. For most people, term life is the smarter choice. Let me explain why. Think about it this way. You need life insurance most when you have dependents, kids, a spouse, a mortgage. Term life gives you maximum coverage during these critical years. A 40-year-old can get a $250,000 term policy for around $162 per year. But whole life? That would cost over $3,500 per year for the same coverage amount. That's over $3,300 saved every year. What could you do with that money? Invest it. Put it in retirement accounts. Build real wealth. Here's my rule. Get term life for 10 to 12 times your annual income. This gives your family enough to survive and rebuild without you. It's that simple. Here's something wild. 72% of Americans overestimate the cost of life insurance. They think it's 3 times more expensive than it actually is. Young people are the worst at this. They believe insurance costs way more than reality. This fear keeps them from buying protection they desperately need. A healthy 30-year-old can get $500,000 of coverage for less than $30 a month. That's less than $1 per day, less than your coffee habit. Don't let myths stop you from protecting your family. The real cost is probably much lower than you think. Get quotes before you decide you can't afford it. Let's move to auto insurance. This is where things get crazy. 1 in 7 drivers in America has no car insurance. That's over 32 million people driving around completely unprotected. And it's getting worse. The uninsured rate jumped from 11% in 2017 to over 15% in 2023. More people are dropping coverage because they can't afford it. But here's what's even more alarming. 1 in 3 drivers is either uninsured or underinsured. That means if they hit you, they can't pay for your damages. This is why choosing the right auto insurance is so important. Let me show you exactly what coverage you need. Auto insurance has several parts. Liability coverage pays when you cause an accident and hurt someone else. Collision coverage pays to fix your car. Comprehensive covers theft, fire, and acts of nature. Most states require liability insurance. The minimum varies by state. But here's the secret. State minimums are usually not enough. If you cause a serious accident, you could be on the hook for hundreds of thousands. Imagine you cause an accident that injures someone badly. Your state minimum might only cover $25,000, but their medical bills could be $200,000. Guess who pays the difference? You do. I recommend getting liability coverage of at least 100/300/100. That's $100,000 per person, $300,000 per accident, and $100,000 for property damage. This protects your savings and your future. Now pay close attention. Uninsured motorist coverage is one of the most important types of protection you can buy, and most people don't even know about it. This coverage pays your bills when someone without insurance hits you. Remember, 1 in 7 drivers has no insurance. If they hit you and can't pay, this coverage saves you. Here's the amazing part. The median cost of uninsured motorist coverage is only $50 per year for bodily injury. That's less than $5 a month for massive protection. Only 21 states require this coverage. If your state doesn't, add it anyway. This small investment could save you from disaster.
Underinsured motorist coverage is different from uninsured coverage. This kicks in when the other driver has insurance, but not enough to cover your costs. Here's a real example. Someone with state minimum coverage hits you. Their insurance only pays $25,000, but your medical bills are $80,000. Underinsured motorist coverage pays the extra $55,000 that their insurance can't cover. Nearly 1 in 5 accidents involve losses that exceed the at-fault driver's coverage limits. That's 20% of accidents where someone gets stuck with bills they can't pay. Get both uninsured and underinsured coverage. The cost is low and the protection is huge. This is non-negotiable. Where you live affects your auto insurance dramatically. Mississippi has the highest rate of uninsured drivers at nearly 30%. New Jersey has the lowest at only 3%. Washington, D.C. has the highest percentage at 25.2%. If you live in these high-risk areas, you need more protection. But here's the good news. States that require uninsured motorist coverage have lower rates of uninsured drivers. The requirement works. Check your state's requirements, then add more protection than the minimum. Your future self will thank you. Now let's talk about your home. 13.4% of homeowners have no insurance. That's about 1 in 8 homes completely unprotected. And it gets worse. 2 out of 3 homes in America are underinsured. People haven't updated their policies to match rising rebuild costs. This is like having car insurance that only covers half your car's value. If something happens, you're still stuck paying for the rest. After the Marshall Fire in Colorado, 74% of homeowners were underinsured. That's nearly 3 out of 4 families who couldn't fully rebuild their homes after disaster struck. If you haven't reviewed your homeowner's insurance in the last 2 years, you're probably underinsured. Let me show you how to fix this. Homeowner's insurance covers 4 main things: your dwelling, the structure of your home; your personal property, your stuff inside; your liability, if someone gets hurt on your property; and additional living expenses, if you can't live in your home. Coverage A is your dwelling coverage. This should equal the cost to rebuild your home, not the market value. These numbers are different. For example, your home might sell for $400,000 but cost $500,000 to rebuild from scratch. If you only insure for market value, you'd be $100,000 short after a disaster. Always get an updated rebuild estimate. Construction costs have skyrocketed. What was enough coverage 5 years ago is probably not enough today. Here's a secret that could save your home. There are 2 types of coverage: actual cash value and replacement cost. The difference is massive. Actual cash value pays what your items are worth today after depreciation. Your 5-year-old couch is not worth what you paid. Replacement cost pays to buy new items. Think about your TV. You bought it for $1,000 3 years ago. With actual cash value, you might only get $300. With replacement cost, you'd get the full amount to buy a new TV. Always choose replacement cost coverage. Yes, it costs a little more each month, but when disaster strikes, you'll be able to actually replace your belongings. The people most likely to go without homeowners insurance are those who can least afford disaster. Homeowners making under $50,000 are twice as likely to be uninsured. 22% of Native American homeowners have no insurance. 14% of Hispanic homeowners and 11% of Black homeowners are uninsured. The southern states are hit hardest. 15.7% of homeowners in the South lack meaningful coverage, and these areas are most vulnerable to hurricanes and severe weather. If you're struggling to afford insurance, there are options. Many states have programs to help. Don't go without protection. If you rent, you still need insurance.
Your landlord's policy covers the building, not your stuff. Renter's insurance protects your personal belongings. Renter's insurance is cheap, usually only $15 to $30 per month. It covers theft, fire, water damage, and more. If someone breaks into your apartment and steals your laptop, TV, and jewelry, without renter's insurance, you'd lose everything. With it, you file a claim and get money to replace your items. Here's what most renters don't know. Renter's insurance also covers liability. If someone trips in your apartment with Place the View, your policy helps pay. Over half of all renters have no insurance. Don't be one of them. For the cost of a few coffees each month, you can protect everything you own. Now let me reveal the biggest secret to saving money on insurance. 76% of people who shop around for insurance save money. Yet 26% of Americans have never compared multiple quotes. That's more than 1 in 4 people who are probably overpaying simply because they never looked at other options. People who reshop their policies save an average of $694 per year. Some save thousands. All it takes is a few hours of comparison shopping. If you haven't compared quotes in the last year, you're almost certainly paying too much. Let me show you exactly how to shop smart. Shopping for insurance is easier than you think. Most people spend between 30 minutes and 2 hours comparing quotes. That's not much time to potentially save hundreds of dollars. Step 1. Gather your current policy information. Look at your declarations page. This shows your coverage limits, deductibles, and what you're paying now. Step 2. Get quotes from at least 3 different companies. Use online comparison sites or contact insurance agents directly. Step 3. Make sure you're comparing apples to apples. Same coverage limits, same deductibles. Only then can you see which company truly offers the best price. Here's another powerful strategy: bundling. Bundling your home and auto insurance saves 15 to 25%. That's hundreds of dollars. State Farm offers discounts up to 25% for bundling, saving customers around $847 per year. Other companies offer 15 to 17%. But some people actually save more by keeping policies separate. It depends on your situation. The only way to know is to compare both options. Get quotes for bundled policies and separate policies. Then pick whichever actually costs less. Don't assume bundling is always better. Want to instantly lower your premium? Raise your deductible. Increasing from $500 to $1,000 can reduce premiums by 15 to 20%. That's $150 to $400 in savings per year, just for being willing to pay more out of pocket if something happens. But here's the warning: only raise your deductible if you have savings to cover it. If you can't afford to pay $1,000 if you crash your car, this strategy backfires. Here's the smart approach: raise your deductible and put the premium savings into a dedicated emergency fund. Eventually, you'll have enough saved to cover any deductible. Insurance companies offer tons of discounts that people never ask about: good student discounts, safe driver discounts, multi-car discounts, military discounts. Good grades can save 5 to 25% on young driver insurance. Many companies also offer discounts for taking defensive driving courses. Some discounts you might qualify for: paying your premium in full instead of monthly, going paperless with electronic documents, being a loyal customer for multiple years. Always ask your insurance company, what discounts am I missing? You might be surprised. They don't always tell you automatically. Here's something most people don't know: your credit score affects your insurance rates. Yes, really. Research shows people who manage credit well make fewer claims. A better credit score can save you hundreds of dollars per year on auto and home insurance. This is another reason to pay your bills on time and manage debt wisely. Think about it. Your credit score affects your ability to get a mortgage, rent an apartment, and now your insurance rates too. One number impacts so many parts of your life.
Check your credit report for errors. Sometimes mistakes drag down your score. Fixing errors could instantly lower your insurance costs.
Modern insurance companies offer something called usage-based insurance. This tracks your actual driving behavior and adjusts your rate accordingly. Programs like Snapshot from Progressive or Drive Safe from State Farm monitor things like speed, braking, and mileage. Safe drivers get big discounts. Studies show usage-based programs can adjust rates by 25 to 31%. Good drivers save, bad drivers pay more. If you know you're a safe driver, this could be a great option. But if you drive fast and brake hard, maybe stick with traditional pricing. Your driving record is one of the biggest factors in your auto insurance rate. Accidents and tickets can double or even triple your premium. One speeding ticket can raise your rates for 3 to 5 years. One at-fault accident, even longer. The best way to keep insurance affordable? Drive safely. Avoid distracted driving, no texting, follow speed limits, keep your distance. If you have a bad driving record, don't lose hope. Many companies will gradually reduce your surcharge as years pass without incidents. Clean driving today saves money tomorrow. Here's a rule you should follow. Review all your insurance policies once a year. 3/4 of people don't shop for new insurance annually, and they're missing savings. Your life changes. You might have paid off your car. Your kids might have moved out. You might have improved your credit score. All these changes can lower your rates. Set a reminder on your calendar. 1 month before each policy renews, get new quotes. See if you can do better. 44% of homeowners and 39% of auto owners didn't compare quotes at their last renewal. Don't make this expensive mistake. There are 2 ways to buy insurance, through independent agents or directly from companies. Each has advantages. Independent agents work with multiple insurance companies. They can shop around for you and find the best deal. This saves you time. Independent agents now control over half of the life insurance market. Their share has grown because they provide value. Direct buying through company websites or apps can be cheaper because there's no agent commission, but you have to do all the research yourself. Choose based on how much time you have. Here's something critical that almost nobody does. Actually read your policy. Most people don't fully understand their coverage. Your policy has a declarations page that shows your coverage limits, deductibles, and premiums. Read it. Make sure it matches what you think you bought. It's like signing a contract without reading it. You might think you agreed to one thing when the document says something completely different. Look for exclusions, things your policy does not cover. Common exclusions include floods, earthquakes, and certain types of water damage. You might need additional policies for these. If something confuses you, ask. Call your agent or company. It's their job to explain. Don't wait until you need to file a claim to discover you're not covered. Not every loss should become an insurance claim. This surprises many people. But filing too many claims can raise your rates or even get you dropped. Here's the rule. If the damage is only slightly more than your deductible, consider paying out of pocket. Filing a $600 claim when you have a $500 deductible only gets you $100, but could raise your rates for years. Think about whether it's worth filing a claim for $150 when that claim might increase your premium by $200 annually for the next 3 years. Save claims for true emergencies, big losses that would seriously hurt your finances. That's what insurance is really for. The ideal insurance customer pays their premium and never files a claim. That's actually the cheapest way to be insured over time. Let's return to something scary. Americans owe at least $220 billion in medical debt. That's $220 billion with a B. More than half of adults with healthcare debt say routine doctor visits caused it. Not emergencies, just normal medical care. 60% cite lab fees and diagnostic tests as major contributors. These routine costs add up when insurance doesn't cover enough. This is why choosing the right health insurance is so important. The wrong plan means you could end up as one of these statistics. Let me show you how to avoid this fate. Here's the truth. Insurance and savings work together. You can't rely on one without the other. 40% of Americans couldn't afford a $400 emergency without borrowing or selling something. That's a problem when your insurance deductible is higher than $400. This is like buying a car without gas. The car is useless if you can't actually drive it somewhere. The ideal setup. Have an emergency fund equal to your highest deductible. If your health insurance has a $3,000 deductible, have at least $3,000 saved. Then, if something happens, you can pay your deductible without going into debt. Insurance and savings together create true financial protection. Here's something powerful that most people don't know. 93% of people who negotiate their medical bills succeed in getting them reduced or eliminated. 93%! That's nearly everyone who tries. Yet only 34% of people actually try to negotiate. Before your insurance even gets involved, ask for itemized bills. Look for errors. Request discounts for paying in cash. Ask about payment plans. Many hospitals have financial assistance programs for people who qualify, but you have to ask. They won't tell you automatically. Be persistent. Here's a critical point about life insurance. Your rates increase 4.5 to 9.2% for every year you wait. The longer you delay, the more expensive it gets. A healthy 25-year-old pays much less than a healthy 35-year-old for the same coverage. And a 45-year-old pays even more. Plus, your health can change. What if you develop a condition that makes insurance expensive or even unavailable? Getting covered while you're young and healthy locks in low rates. 40% of insured people wish they had purchased earlier. Don't wait. If you need life insurance, get it now. How much life insurance do you actually need? There's a simple formula. Most experts recommend 10 to 12 times your annual income. If you make $50,000 per year, you'd want $500,000 to $600,000 in coverage. This gives your family enough to replace your income for about a decade. But also consider your mortgage balance, your other debts, your kids' future education costs. These might increase the amount you need. A better formula: add up what your family would need for 10 years, plus all your debts, plus future expenses. That's your ideal coverage amount. Don't underinsure. Yes, more coverage costs more, but the whole point is to protect your family. Don't leave them short. Every state sets minimum auto insurance requirements. But here's the secret. These minimums are almost never enough. Some states require only $15,000 in bodily injury coverage per person, but the average cost of treating car accident injuries can be $50,000 or more. If you cause an accident and the victim's injuries cost $80,000, but your policy only covers $25,000, you're personally responsible for the remaining $55,000. Meeting the legal minimum isn't the same as being properly protected. Think of minimum coverage as the floor, not the ceiling. I recommend at least 100/300/100 in liability coverage. This protects your savings, your assets, and your future income from lawsuits. If you have a car loan or lease, you need to know about gap insurance. This could save you from disaster. Here's the problem. Cars lose value fast. If your car gets totaled, your regular insurance only pays what the car is worth today, not what you owe on your loan. You bought a car for $30,000. 2 years later, it's worth $20,000, but you still owe $25,000 on your loan. If it's totaled, insurance pays $20,000, but you still owe the bank $5,000 for a car you don't even have anymore. Gap insurance covers that difference. It pays the gap between what you owe and what your car is worth. If you're financing or leasing, get gap coverage. Once you've paid down your loan enough that you're no longer underwater, you can drop it.
Let me introduce you to Umbrella Insurance. This is like a super shield that sits on top of all your other policies. Umbrella Insurance provides extra liability coverage beyond your auto and home insurance limits, usually sold in million-dollar increments. Imagine you cause a serious accident and get sued for $2 million. Your auto insurance only covers $300,000. Without umbrella insurance, you'd lose everything trying to pay the rest. With umbrella insurance, you're covered. Who needs umbrella insurance? Anyone with assets to protect. A house, savings, investments? These can all be taken in a lawsuit. Umbrella insurance is surprisingly cheap, often only $200 to $400 per year for $1 million of coverage. That's incredible value. Here's something that surprises many homeowners. Standard homeowners insurance does not cover floods. You need a separate policy. Most flood insurance comes through the National Flood Insurance Program, NFIP. You can buy it through regular insurance agents. And here's the mistake people make. They think floods only happen near coasts or rivers, but over 25% of flood claims come from outside high-risk zones. Climate change is making floods more common in more places. If your home could possibly flood, get coverage now. There's usually a 30-day waiting period before it takes effect. Just like floods, earthquakes are not covered by standard homeowners insurance. You need a separate policy. And it's not just California. Earthquakes can happen in many parts of the country. The New Madrid Fault in the Midwest could produce massive quakes. Most people think earthquakes are a California problem, but states like Oklahoma, Alaska, and even Missouri have significant earthquake risk. Earthquake insurance is expensive, especially in high-risk areas. But consider the alternative, losing your entire home with no coverage. If you live in an earthquake zone, at least get a quote. Know what protection costs so you can make an informed decision. Here's the most overlooked insurance of all, disability insurance. Very few Americans have adequate disability coverage. What happens if you get sick or hurt and can't work? How do you pay bills? This is where disability insurance steps in. It replaces your income. Think about it. Your ability to earn money is your most valuable asset. If a professional athlete insures their legs, shouldn't you insure your ability to work? There are two types. Short-term disability covers weeks to months. Long-term disability covers years or until retirement. Most people focus on dying, but you're actually more likely to become disabled during your working years than to die. This insurance matters. Before you buy insurance on your own, check what your employer offers. Over half of insured Americans get coverage through work. Many employers subsidize health insurance, paying part of your premium. This makes workplace coverage often cheaper than buying on your own. But don't assume workplace coverage is enough. Employer-provided life insurance often covers only 1 or 2 years of salary, not enough for most families. Review your workplace benefits during open enrollment. Maximize what your employer offers, then fill gaps with individual policies. For health insurance, timing matters. Open enrollment happens once a year, usually in the fall. Miss it, and you might be stuck until next year. During open enrollment, you can change plans, add coverage, or enroll for the first time. Outside this window, your options are limited. Special enrollment periods exist for major life events. Getting married, having a baby, losing job-based coverage. These qualify you to enroll outside the normal window. Put open enrollment dates on your calendar. Don't miss this chance to review and improve your coverage. Beyond your main policies, there are supplemental insurances that can fill gaps. Accident insurance, critical illness insurance, and fixed indemnity plans. Accident insurance pays if you get injured, extra money for ER visits, x-rays, hospital stays. Critical illness pays a lump sum if you're diagnosed with cancer, heart attack, or stroke. These supplements are especially valuable if you have a high-deductible health plan. They help cover those initial out-of-pocket costs before your main insurance kicks in. These policies don't replace major insurance, they supplement it. They provide extra cash when you need it most.
Consider supplemental coverage if you have high deductibles or work in a risky job. The premiums are usually small compared to the potential benefit. Yes, PET insurance is a real thing, and it's growing fast as vet costs keep rising. Veterinary care has gotten expensive. Emergency surgery for a dog can cost $5,000 or more. Pet insurance helps cover these unexpected bills. Like all insurance, pet insurance has premiums, deductibles, and coverage limits. Shop around just like you would for your insurance. If your pet is a family member and an unexpected $10,000 vet bill would devastate your budget, pet insurance might be worth considering, but do the math first. Beware of insurance scams. Criminals know people want to save money, and they exploit this. Red flags include prices that seem too good to be true, pressure to buy right now, requests for payment in cash or gift cards, no written policy documents. Legitimate insurance companies don't ask you to wire money, pay with cryptocurrency, or make decisions within the next 5 minutes. Any of these should make you walk away immediately. Always verify the company is licensed in your state. Check with your state's insurance department. They have lists of authorized companies. If something feels wrong, trust your gut. Legitimate insurers won't rush you or use high-pressure tactics. Take your time. Technology has made insurance easier than ever. Use it to your advantage. Comparison websites let you get multiple quotes in minutes. Apps help you track claims and access your insurance cards. Online portals let you manage policies 24/7. InsurTech startups like Lemonade and Hippo offer streamlined digital experiences. They're changing how people buy and use insurance. But don't let convenience make you lazy. Still read your policy. Still understand your coverage. Digital tools help, but you still need to pay attention. When disaster strikes, documentation is everything. Start preparing now before you need it. Only 47% of homeowners have prepared an inventory of their possessions. That means over half would struggle to prove what they owned if everything was destroyed. Walk through your home with your phone and record video of every room, every closet, every drawer. Keep the video in cloud storage so it survives even if your house doesn't. Keep receipts for expensive items. Take photos of serial numbers. Store copies of important documents in the cloud where fire or flood can't destroy them. Doing this now, when nothing is wrong, makes filing claims so much easier later. Don't wait until you need it. Remember, your insurance needs change over time. Many people are underinsured because they haven't updated policies. Home renovation? Increase your coverage. New baby? Add life insurance. Paid off your car? Maybe drop collision coverage if it's old. Major life events that should trigger insurance reviews: marriage, divorce, birth of child, buying a home, starting a business, retirement. Make insurance review part of your annual financial checkup, right along with checking your credit report and reviewing your investments. Here's something important. Teach your kids about insurance. Financial literacy helps them avoid the mistakes so many adults make. When they get their first car, involve them in choosing auto insurance. When they move out, explain why they need renter's insurance. When your teenager starts driving, sit down together and get quotes. Show them how their driving record, the car they choose, and their grades all affect how much insurance costs. Young people who understand insurance make better decisions. They're less likely to go uninsured. They're more likely to shop around. Breaking the cycle of financial ignorance starts at home. Don't assume schools will teach this, because they probably won't. Let me warn you about the biggest mistakes people make with insurance. Avoid these, and you'll be ahead of 90% of people. Mistake 1. Buying minimum coverage to save money. This leaves you exposed to catastrophic losses. Mistake 2. Never shopping around. Remember, 76% of people who compare quotes save money. Mistake 3. Not reading your policy. You might be covered for things you don't know,
or not covered for things you assume. Mistake 4. Waiting to buy life insurance. Every year you delay costs you 4.5 to 9.2% more. Start now.
Here's your action plan. Follow these steps, and you'll have complete insurance protection. Step 1. List all the insurance you currently have: health, life, auto, home, other. Step 2. Review each policy. Do your coverage limits make sense? Are your deductibles right for your savings? Step 3. Get quotes from at least 3 other companies. See if you can save. Step 4. Fill the gaps. Missing life insurance? Need umbrella coverage? Fix these now. Step 5. Set reminders to review everything annually. Let's recap the most important points from this entire course. 100 million Americans are uninsured or underinsured. Don't be one of them. 2/3 of bankruptcies are caused by medical bills. Proper insurance prevents this. Shopping around saves hundreds of dollars. Bundling can save 15 to 25%. HSAs provide triple tax benefits. Term life is usually better than whole life. Get uninsured and underinsured motorist coverage. Update your homeowner's insurance to match rebuild costs. Review everything annually. Start now while you're young and healthy. You've just learned more about insurance than most people know in their entire lives. You understand premiums, deductibles, and coverage types. You know how to shop smart and find discounts. You understand why insurance matters and how to choose the right policies. Insurance isn't exciting, but it is essential. It's the foundation that lets you take risks, build wealth, and live without constant fear of disaster. Now go, review your policies, get quotes, fill the gaps, protect yourself and your family. Because the best time to get insurance is before you need it. Thank you for watching, and I'll see you in the next one.